getting started with investing in Indian mutual funds. Welcome to the deep dive. Today, we're really tackling something important, getting started with investing in Indian mutual funds. Our mission here is to take all this great source material you shared, unpack it, and give you a practical roadmap. We want to help you understand how to build wealth using something like a moderate risk SIP portfolio. Just demystify the whole thing.
And it's great material we have, really comprehensive. It sets us up perfectly, I think, for a deep but, understandable look at how to approach this strategically in India.
Okay, so let's unpack this, starting right at the beginning. Why mutual funds? Why are they such a compelling option for investors in India? What are the real core advantages?
Well, the sources point to a few key things. First, there's the professional management. You've got experienced pros managing these funds. These aren't just people picking stocks. They're doing deep research, managing the portfolio constantly. And in India's market, their ability to react to, say, regulatory changes or market shifts, that's huge, something most individuals just don't have the time or, frankly, the expertise for.
Right, so it kind of levels the playing field, makes that high-level know-how accessible, even if you're starting small.
Exactly. And that flows right into the second big plus, diversification. Instead of you trying to pick, 5 or 10 stocks, a mutual fund pools money. It buys a whole range of securities. So if one stock or even one whole sector has a bad run, it doesn't sink your entire investment. It spreads the risk.
That diversification definitely offers some peace of mind. But getting that peace of mind means, getting started. What about accessing these funds? Compliance.
Yeah, good point. That's the third advantage the sources highlight, accessibility and compliance. These funds in India are regulated by SEBI, the Securities and Exchange Board of India. That means strong oversight, transparency, rules to protect you, the investor. Plus, they're super accessible. Residents, NRIs. You can often start with pretty small amounts, usually through online platforms.
Okay, so let's say you're convinced. Mutual funds look like the right path. What's the absolute first practical step you have to take?
Right, the first hurdle, if you want to call it that, is KYC. Know your customer. It's basically a one-time verification, mandatory. You'll need your PAN card, that's essential, the permanent account number, then standard proofs, ID and address, think Aadhaar, passport, that sort of thing, and a recent photo.
Okay, documents in hand. How do you actually do the KYC? Is it complicated? Online? Offline?
You've got options. There's online eKYC. You could opt to do this through KRA websites like CAMS or Carvey or maybe the Fundhouse AMC website itself. You basically enter your PAN, upload scans of your documents, and then verify, usually with an OTP sent to your Aadhaar-linked number. Sometimes there's a quick video call thing, an IPV in-person verification. Usually gets done in a few working days. And it's worth noting, newer SEBI rules often push for Aadhaar-based eKYC for full investment access without limits.
And if you prefer doing things face-to-face, or maybe don't have everything set up for online.
Yep, there's the offline route too. You fill out a physical KYC form, attach copies self-attested of your documents and your photo, then you submit it in person. Could be at a Fundhouse branch, a KRA office, or an RTA like CAM. You'll do an in-person verification there too, where they check your originals. This way takes a bit longer, maybe up to 10 working days. Oh, and remember, KYC is usually one time. But if your original KYC used older documents, you might need to update it, probably with Aadhaar, to comply with the latest rules. And importantly, everyone needs their own KYC primary holder, joint holders, NRIs, even minors, through their guardian.
Okay, so KYC done. Your investment passport is stamped. Now the fun part. Where do you actually go to invest?
Right. You can go direct to the source, the asset management companies, AMC-owned website, or, and this is really popular, you can use aggregators or brokers. They Grow, Zero to Coin, Paytm Money, Kuvera, those kinds of platforms. They're convenient because, everything's in one place. Easy to see all your investments, get statements, track how things are going.
Makes sense. So we've got the how sorted. Now the what, the fund landscape seems huge. How do we start categorizing them? What are the main types we should know?
Yeah, it can look overwhelming, but the sources break it down nicely into main fund categories. First, equity funds. These invest mainly in stocks, aiming for capital growth. Good for longer timelines, say 5 years plus. Then debt funds. They invest in things like bonds, fixed income stuff, more about steady income, preserving capital. Lower risk, generally. Hybrid funds mix the two, equity and debt. They try to balance risk and return. And finally, commodity funds, often focusing on gold. People use these sometimes as a hedge against inflation or market wobbles.
Interesting. And within those big buckets, it gets even more specific, right? Let's dive into some of those subtypes.
Exactly. Take equity funds. You've got large cap funds investing in India's top 100 biggest companies, generally seen as less volatile, maybe more stable returns, than mid cap and small cap funds. They invest in smaller companies, so there's potential for higher growth, but definitely more volatile, more risk. Multi-cap funds spread their bets across large, mid, and small cap stocks, gives you broad equity exposure. And don't forget index funds or ETFs. These are passive. They just track an index like the Nifty 50 or Sensex, usually have lower fees because there's less active management.
Okay, so lots of flavors within equity depending on your risk appetite and growth goals. What about the debt side subtypes?
Sure. For debt funds, you might see corporate bond funds, investing in bonds issued by companies, usually high-rated ones, moderate risk. Gilt funds invest in government securities, very low risk, backed by the government. Short-term debt funds are for parking money for, well, shorter periods, low risk, focused on liquidity. And hybrid funds, they vary too. Like aggressive hybrid has more equity, maybe 65–80%. Conservative hybrid has more debt. They try to smooth out the ride. The sources also mention things like gold ETFs funds for direct gold exposure, and even international funds if you want to diversify geographically outside India.
Right, so many choices. It sounds like just picking one isn't the strategy. It's about how you combine them. Let's talk diversification strategies.
Absolutely critical. Diversification isn't just about owning different funds. It's about how you spread the money. First, across asset classes. Don't put everything in equity or everything in debt. Mix equity, debt, maybe some hybrid, maybe a bit of gold. That's your first layer of defense against volatility. Then, within equity funds, even if you decide on, say, 60% in equity, don't put it all in one type. Spread it across large cap, mid cap, maybe some multi-cap or small cap, depending on your risk profile. Reduces the risk of one market segment dragging you down.
Okay, so diversifying within the equity portion too. What else?
You can think about investment style. Some funds focus on growth stocks, others on value stocks. Some try to find growth at a reasonable price or gear up. Mixing styles can help. Also, management style. Mix actively managed funds where the manager is picking stocks with passive funds like index funds or ETFs. Balances potential outperformance with lower costs. And lastly, maybe don't put all your money with just one AMC fund house or one-star fund manager. Spreading across different managers and companies reduces operational risks or the risk of one manager underperforming.
That makes a lot of sense. But is this diversification something you set up once and then just leave it? Or is it more active?
Oh, definitely not set and forget. The sources really stress regular review and rebalancing. At least once a year, you should look at your portfolio, see how things have performed. Has your asset allocation drifted? Maybe equities did really well, and now they're a bigger slice of the pie that you intended. Rebalancing means selling a bit of what's gone up and buying a bit of what's gone down to get back to your target allocation. It keeps your risk level consistent and aligned with your goals.
Okay, this leads perfectly into SIPs, systematic investment plans. We hear about them constantly. What exactly is a CSP, and why is it considered such a core tool for building wealth in India?
A CSIP is actually pretty simple in concept. It's just a way to invest a fixed amount of money into a mutual fund automatically at regular intervals, usually monthly. The real power. It takes market timing out of the equation. You're not trying to guess the highs and lows. You just invest consistently. It builds discipline.
And the benefits seem huge. Can you break down why they work so well?
Yeah, there are a few key benefits. The big one is rupee cost averaging. Because you invest the same amount each time, you automatically buy more units of the fund when the price is low and fewer units when the price is high. Over time, this averages out your purchase cost, often lower than if you tried to time the market. And, psychologically, it stops you from freaking out and not investing when markets are down, which is often the best time to buy. Then there's the classic, compound interest or compounding returns. Your returns start earning their own returns. Over the long term, this is where the real wealth growth happens. It's exponential. And finally, behavioral discipline. SIPs automate investing. It stops you from making emotional decisions like panic selling when the market dips or getting greedy when it's high. You just stick to the plan.
It sounds powerful because it's simple and disciplined. What are some best practices the sources mention for making the most of a SIP?
Good question. The sources highlight a few key things. Number one, start early and stay invested for the long term. Compounding needs time to work its magic. Two, if you can, increase your SIP amount regularly. Maybe annually, say by 5% or 10% as your income grows. This really turbocharges the accumulation. Three, diversify your SIPs. Don't just do one SIP into one fund. Maybe have SIPs going into a large cap, a mid cap, maybe a hybrid fund, reflecting your overall asset allocation. And four, same as the overall portfolio. Review and rebalance annually. Make sure your SIP investments still align with your goals and risk tolerance.
Okay, let's make this really concrete. Our source material actually provides a practical example, a moderate risk portfolio plan investing $15,000 per month via SIP. Can you walk us through that?
Sure, this example plan aims for a moderate risk profile. Here's the breakdown of the U200,000 monthly SIP. Equity funds. Get the largest chunk, 55%, which is $8,254 per month. The examples given were funds like Tata Large Cap, UTI Mid Cap, ICICI Pru Blue Chip. So a mix within equity. Hybrid funds. Allocated 15%, so 2,250 monthly. The example was HSBC Aggressive Hybrid. Debt funds. Received 25%, that's 3,750 per month. Examples included ICICI Pru Corporate Bond and Access Short-Term Fund. And commodity funds. Gold. A smaller slice, 5%, which is 750 monthly. Nippon India Gold BS ETF was the example here.
Right. I see the allocation follows the diversification principles we talked about. What's the thinking behind those specific percentages for a moderate risk profile?
Exactly. The 55% in equity provides the main engine for growth, using a mix of large and mid-cap aims for growth, but maybe avoids the extreme volatility of purely small-cap focused strategy. The 15% in hybrid acts as a kind of shock absorber, blending equity and debt to smooth out the portfolio's overall ups and downs. The 25% in debt adds stability and potentially more predictable returns, kind of like an anchor, especially useful when equity markets are choppy. And that small 5% in gold, that's the hedge. Protection against inflation or a buffer if there's a major market downturn. It's about balance.
Okay, this is where it gets really motivating for people seeing the potential numbers. The source is projected what this 15,000 month SIP could grow to. What did they show over, say, 5 years?
Yeah, the projections really help visualize the goal. So investing 15,000 a month for 5 years means you've put in 9,000 total. Now, assuming different return rates, with a conservative 8% annual return, the estimated value might be around 11,011,000. That's a gain of about 2,011,000. At a moderate 12% annual return, the value could be closer to 11 million euro less than 1,000, a gain of 2,061,000. And if things go well, with an aggressive 15% annual return, maybe 12,000, so a gain of 3,000,000.
Interesting, but the real kicker, as the sources emphasize, is the long term, right? What happens if you stick with that 15,000 SIP for 10, 15, even 20 years?
This is where compounding truly shines. Let's stick with that moderate 12% annual return assumption. After 10 years, you've invested 18 lakh total. Estimated value, maybe 27.81 lakh. That's nearly 10 lakh in gains. Search it to 15 years. You put in 27 lakh. Estimated value could be around 51.28 lakh. Gains of over 24 lakh. And at 20 years, total investment is 36 lakh. The estimated value could be a whopping 86.62 lakh. That's over 50 lakh in gains.
Wow, those numbers really ramp up. And if you manage that slightly higher, 15% return.
Then it gets even more impressive. Same euro 15,000 SIP, but assuming 15% annual return. 10 years. Invested 18 lakh, potential value 31.0 lakh. Gain 13.10 lakh. 15 years. Invested 27 lakh, potential value over 62.90 lakh. Gain nearly 36 lakh. And 20 years. Invested 36 lakh. Potential value could cross the crore mark, maybe 1.20 euro crore. That's a gain of over 84 lakh. The takeaway from looking at these projections is just undeniable. Most of the growth happens in those later years. It hammers home why starting early, staying invested, and maybe even bumping up that SIP amount over time is so incredibly important.
Okay, let's wrap this up. Thinking about everything we've covered, drawing from these sources, what's the essential wisdom for someone wanting to invest in Indian mutual funds?
I think the key takeaways are mutual funds are a really solid option. Professional management, diversification, accessibility, and regulation. Diversification is key across assets, within assets like equity, even across fund houses. Don't put all your eggs in one basket. SIPs are your friend. They build discipline, leverage repeat cost averaging, and unlock compounding. They make investing systematic. That moderate risk portfolio example, 55% equity, 15% hybrid, 25% debt, 5% gold, gives a practical starting point for balancing growth and stability. Long term is what it's at. Think 10, 15, 20 years to really see the power of compounding multiply your money. And finally, you need to review and rebalance regularly, at least annually. And crucially, don't panic sell during market dips. Stay the course.
That really distills it well. So maybe the final thought for you, the listener, is this. Building serious wealth through mutual funds in India. Yes, it's about understanding the mechanics we've discussed, but maybe even more, it's about cultivating patience. It's about discipline. The real power isn't trying to be clever and time the market perfectly. It's about showing up consistently month after month, year after year, and letting things like rupee cost averaging and compounding do their slow, steady, but ultimately incredible work over the long haul. Resisting those emotional reactions, that might be the hardest but most rewarding part.